The numbers don't make sense anymore. Corporate profits have flatlined. Debt has hit record highs. And yet, the stock market keeps climbing. S&P 500 at record levels. Nasdaq within striking distance of its all-time high. No crash. No correction. No reckoning. It's as if the laws of gravity stopped applying to finance. Between 2020 and 2025, the world watched governments print over $25 trillion in combined stimulus and liquidity programs. The Federal Reserve alone added $8 trillion to its balance sheet. Interest rates swung from 0 to 5% in under 2 years, the fastest tightening in modern history. By every textbook metric, that should have triggered a crash. But it didn't. And that's where the story begins, with a quiet alliance between central banks, investment banks, and the algorithmic infrastructure that now runs global markets. It's not a secret cabal. It's a system managed by names you already know. The Federal Reserve, J.P. Morgan, Citadel Securities, BlackRock, and the U.S. Treasury. Each plays a different role, but together, they form the invisible scaffolding that keeps the market afloat. The Fed provides the liquidity. The banks provide the leverage. The asset managers provide the distribution. And the algorithms provide the illusion of stability. They don't meet in smoke-filled rooms. They meet in data, daily repo markets, bond auctions, and automated trading systems that quietly move trillions of dollars across the globe every hour. This isn't conspiracy. It's coordination, built into the code of the modern market. After the 2008 crash, regulators tried to make the system safer. But safety came with a side effect, dependency. The Fed became the ultimate backstop, the market's emergency oxygen tank. Whenever volatility spikes or liquidity dries up, banks and funds know exactly what to expect. Lower rates, bond buying, swap lines, or bailout programs with new acronyms. Investors call it the Fed put. It's not written anywhere, but everyone acts like it's real, because for 15 years, it has been. And that belief alone has become the market's greatest stabilizer. So why hasn't the stock market crashed yet? Because the people who control its plumbing can't afford to let it. Not yet. Every pension fund, every 401k, every government deficit, and every bank balance sheet depends on prices staying high. If they fall too far, the entire system starts to unwind. And for the first time in history, the system itself is too big to fail. But here's the question no one wants to answer. If the market is being held up, how long can they keep it there? When the 2020 pandemic sent markets into freefall, the Federal Reserve stepped in faster than ever before. Within weeks, it announced programs that dwarfed 2008, $700 billion in bond purchases, zero interest rates, and direct lending to corporations through the primary market corporate credit facility. The message was unmistakable. The stock market is national security. That response trained the entire financial world to expect one thing: protection. Whenever something breaks, the Fed fixes it. Whenever the system wobbles, liquidity floods in. By 2025, this safety net has grown into something permanent, not just policy, but expectation. And expectations drive markets more than earnings ever could. To understand why the market hasn't crashed, you have to look beneath the surface, into the plumbing. The modern financial system runs on daily transactions called repos, repurchase agreements. These are short-term loans between banks, hedge funds, and the Fed, usually lasting just 24 hours. Every night, trillions of dollars of collateral, mostly U.S. Treasury bonds, move through this system. If the repo market freezes, credit stops, liquidity vanishes, and the stock market collapses within days. That's exactly what happened in September 2019, when overnight repo rates spiked to 10%. The Fed quietly intervened, injecting hundreds of billions. Crisis averted. Since then, the Fed has made sure it never happens again. Through permanent, standing repo facilities, it's now a lender of last resort, every single day. That means there's always someone willing to lend. Always someone willing to buy. But liquidity alone doesn't stop crashes, it just buys time. The real stability comes from algorithms. High-frequency trading firms like Citadel Securities, for2, and Jane Street now dominate U.S. equity trading. They account for more than 70% of all market volume. These algorithms aren't just reacting, they're preempting. They detect volatility spikes and instantly adjust liquidity, smoothing out sharp drops before they spread. In other words, The crash doesn't happen because it's absorbed in real time. The same code that caused flash crashes a decade ago now prevents them, most of the time. It's not natural stability. It's manufactured calm. Institutional investors, pension funds, sovereign wealth funds, insurance companies hold over $100 trillion globally. They can't exit the market, even if they wanted to. There's nowhere else for that amount of capital to go. So instead of pulling out, they hedge, rotate, or wait. Corrections become micro-fluctuations. Bear markets die in weeks. And the illusion of permanent prosperity continues. Behind the scenes, major banks play their own balancing act. J.P. Morgan, Bank of America, Goldman Sachs, all rely on rising asset prices to support their balance sheets. When stocks fall, so do the values of their collateral, their loans, their client portfolios. To prevent that, they use derivatives, futures, options, swaps, not to bet on direction, but to control volatility. By suppressing volatility, they protect credit markets. And when credit markets stay stable, stocks rarely crash. It's not manipulation in the traditional sense. It's self-preservation. Then there's the international layer. Foreign central banks, Japan, Switzerland, China, hold trillions in U.S. assets. If U.S. markets collapse, their currencies and reserves suffer instantly. That's why, during every global scare, from Evergrande to Ukraine, liquidity floods into U.S. markets, not out. The worse the world gets, the stronger the dollar becomes. The more chaos, the more capital flows to Wall Street. The stock market doesn't crash because it's too essential to global stability to be allowed to. But holding up the market this long comes with a cost. Because every time the system avoids pain, it stores energy, like a spring wound tighter and tighter. And when the release finally comes, it won't be a typical crash. It will be the failure of control itself. What happens when the cure becomes the disease? That's the quiet truth behind the modern market. Every safety net, every intervention, every temporary policy created after 2008 was meant to stabilize the system. But over time, it built a dependency so strong that the markets can't function without it. Investors no longer price assets based on risk. They price them based on how much the Fed will tolerate before stepping in. The result? A market that no longer reflects the economy, it reflects policy. The U.S. now carries over $35 trillion in federal debt, and total global debt has surpassed $310 trillion. Every percentage point increase in interest rates adds hundreds of billions to borrowing costs. If asset prices fall significantly, tax revenues collapse, and deficits explode. That's why governments, consciously or not, need markets high. The financial system and the political system are now fused. If one breaks, the other falls with it. That's why there's no crash. Not because the economy is strong, but because the cost of a crash is now unpayable. The Fed has two mandates, stable prices and full employment. But it quietly gained a third, stable asset prices. Whenever rates rise too far, markets begin to shake. When they shake, liquidity drains. And when liquidity drains, credit markets freeze, threatening jobs, pensions, and tax receipts. So each time the Fed tries to normalize policy, something breaks. In 2019, it was the repo market. In 2020, it was corporate debt. In 2023, it was regional banks. Each accident forced the Fed to step back in, proving that normalization isn't possible anymore. The system can't survive on its own. The same algorithms that keep markets smooth have learned to anticipate Fed behavior. They trade not on earnings or innovation, but on central bank tone, speech, and posture. When Jerome Powell pauses, markets rise. When he frowns, they dip. When he reassures, they rally again. The machines aren't following fundamentals, they're following confidence signals. It's not investing. It's feedback. The market doesn't crash because the code itself is wired to prevent it, until it can't. Then there's the human layer. Since 2020, tens of millions of retail investors joined the market, through apps like Robinhood, Fidelity, and Webull. Stimulus checks became capital. Memes became strategy. Retail money now accounts for about 25% of all U.S. trading volume. And much of it flows automatically into index funds, the same passive structures that never sell unless forced. That's why dips are short. That's why buy the dip became culture. It's not confidence, it's automation disguised as optimism. Meanwhile, the big banks, JP Morgan, Bank of America, Goldman, hold mountains of long-term treasuries that lose value when rates rise. They can't sell them without booking massive losses. They can't keep them without bleeding liquidity. So they do the only thing they can: hedge, delay, and lobby for policy relief. Their balance sheets depend on markets staying calm. Every rate hike is a potential spark. Every sell-off threatens solvency. So the banks and the Fed have become partners in survival, two sides of the same coin. Markets have always adapted. But this adaptation is different. It's structural. We've entered an age where risk isn't removed. It's repackaged and deferred. The volatility hasn't vanished. It's been pushed downstream. Into pensions, into real estate, into currencies, into trust. That's why the stock market hasn't crashed. It's not because it's safe. It's because the risk has been exported somewhere you can't see. But where did all that hidden risk go? And what happens when the people holding it, the ordinary investor, the retiree, the saver, realize the safety net was built with their own money? In Phoenix, Linda Harper, 68, checks the balance on her retirement account. She doesn't trade stocks. She simply lets her 401k sit in an S&P 500 index fund. The number keeps going up, even though the news keeps warning of recession. It feels comforting until she looks closer. Nearly every dollar of her savings is invested in the same tech and financial giants that dominate the indexes. If those fall together, she falls with them. Her diversified portfolio is really just a mirror of the system's biggest risks. She doesn't know it, but part of her money is recycled daily through repo markets and derivatives. She's funding the machine that keeps itself afloat. Across the country in Chicago, Eric Santos, a derivatives trader at a mid-size hedge fund, starts his morning watching volatility indexes instead of earnings reports. He no longer trades companies. He trades behavior. He can feel when the Fed is nervous just by how options are priced. Each morning's trades are hedged against a possible intervention. When Powell speaks, Eric listens closer than he ever listened to his own CEO. His job is no longer about prediction. It's about alignment with central bank rhythm. If the system ever stops humming, he has no playbook. In Atlanta, Dana Kim, who runs a small manufacturing company, notices something strange. Credit lines are cheap when stocks rise and tighten whenever the market wobbles. Her access to capital depends on Wall Street's mood. When the market feels safe, her bank calls her a valued client. When it doesn't, paperwork doubles and rates spike. She's running a real business in a financialized world where confidence is currency. Meanwhile, in Washington, Deputy Treasury Undersecretary Michael Lewis meets with Federal Reserve staff. They aren't talking about unemployment or manufacturing. They're talking about market functioning. Because if the stock market seizes up, consumer confidence collapses, and every political goal becomes impossible. Policy has become performance maintenance. The market isn't following government anymore. Government is following the market. We've seen this movie before. In the late 1980s, Japan built its own version of a never-crash market. Asset prices rose endlessly. The Bank of Japan protected liquidity. Corporations cross-owned each other's shares. Everyone believed the system was self-stabilizing. Then, in 1990, the illusion cracked. Real estate values fell, stock portfolios collapsed, and an entire generation's wealth evaporated. Japan didn't implode overnight. It stagnated for 30 years. A slow-motion crash that never looked dramatic, but hollowed the economy from within. Today's United States isn't Japan 1990, but the rhyme is unmistakable. When policy replaces price discovery, crashes don't disappear, they stretch out in time. Every soft landing, as victims you don't see. Savers earning near-zero returns, first-time homebuyers priced out, workers whose wages lag inflation while asset owners grow richer. The absence of a crash doesn't mean the absence of pain. It just redistributes it, downward. Linda's pension fund, Eric's algorithms, Dana's credit line, Michael's policy brief, all depend on the same premise. That confidence will never run out. But confidence is not infinite. It's earned, borrowed, and eventually tested. The next real test won't be a Lehman-style explosion. It will be a silent stall, liquidity evaporating, trust fading, algorithms pausing for confirmation. That's when everyone realizes the no-crash era was simply the longest calm before the shift. History doesn't repeat, but it always asks the same question. When a system grows too dependent on protection, what finally breaks it? The crash itself, or the belief that it can't crash at all? The stock market hasn't crashed because it can't, not yet. It's not a reflection of the economy anymore. It's the mechanism holding the economy together. The entire system has become reflexive. It looks at itself to know what it's worth. When the Fed speaks, the market moves. When the market moves, policymakers respond. When policymakers respond, investors believe. That circular faith has kept the illusion alive. The illusion that someone, somewhere, is in control. But the truth is simpler and far more fragile. No one is. By 2025, the U.S. economy has become addicted to high asset prices. Homeowners need them to borrow. Corporations need them to refinance. Governments need them to fund deficits through capital gains taxes. The Fed knows that even a 20% correction could ripple into a fiscal crisis. So it carefully calibrates policy, word by word, like a surgeon avoiding a fatal nerve. But precision doesn't mean safety. When every variable is interconnected, control becomes an illusion of stability, not the presence of it. And every illusion has a breaking point. It won't look like a crash at first. It'll look like a pause, fewer buyers, thinner volume, temporary dislocations in liquidity. Then something small will break, a regional bank, a pension fund, a derivatives counterparty. Nothing major, at least not at first. But confidence will twitch. Algorithms will slow down. Credit will tighten. And then, slowly, everyone will realize what they've built. A financial system that's too synchronized to fail cleanly. When one part trembles, the entire structure resonates. The everything bubble won't pop, it will deflate in slow motion. The market doesn't crash because of bad news. It crashes when people stop believing that someone else will save it. That's the faith that's kept everything standing. The belief that the Fed, the banks, the algorithms, or the government will catch the fall. But faith is not a financial instrument. And once it's lost, you can't reprint it. So the question isn't, when will the market crash? It's what happens when the people realize the crash has already begun, quietly, invisibly, under the surface. Linda in Phoenix doesn't watch CNBC anymore. Her account balance is still rising, but her grocery bill rises faster. Eric in Chicago still trades volatility, but he's noticed his models are less predictive. Dana in Atlanta just got a letter from her bank. Her credit line is being reviewed. And Michael in DC drafts another report assuring everyone that markets remain orderly. Each of them is doing their part to maintain the illusion, not out of greed, but necessity. Because when a system grows this large, belief itself becomes policy. Maybe the reason the stock market hasn't crashed is the same reason it eventually will. Because everyone believes it can't. That belief props up every pension, every 401k, every quarterly report. It's the oxygen the system breathes. But belief without fundamentals is not stability, it's suspension. And suspension always ends the same way, with gravity. If you've made it this far, here's the truth the banks won't say. The market doesn't tell you the state of the economy. It tells you the state of confidence. Confidence can vanish in a single headline, a single failed auction, a single signal that the protector has lost control. You can't stop the system from resetting, but you can stop being surprised by it. Learn what your money depends on. Understand the structure, not the story. Because when the illusion fades, the people who understand why it was built are the ones who rebuild what comes next. The stock market hasn't crashed yet, because the real crash isn't a fall in prices. It's the moment everyone realizes they were never standing on solid ground.